Something just happened in the silver market that almost nobody on mainstream financial media is talking about. A quiet decision, a 22% margin cut, and it could completely change the direction of silver in the coming weeks. Most investors are watching the price chart, waiting for the next breakout. But behind the scenes, the rules of the game just shifted. And when the rules change in the futures market, prices can move fast, sometimes violently. The question is simple. Is this margin cut about to ignite a rally? Or is it a warning sign that silver is actually in trouble? Before we go deeper, if you follow the silver market, the global economy, and the hidden forces moving precious metals, make sure you like this video and subscribe to the channel. Here on Past and Profit, we break down the real stories behind gold, silver, and the financial system in simple terms that help you understand what's really happening. Now let's talk about the 22% margin cut that nobody seems to be discussing. In the world of futures trading, margin requirements are one of the most powerful tools exchanges have. Most everyday investors never hear about them, but for professional traders, hedge funds, and large institutions, margin rules can change everything. Margin is basically the amount of money a trader must deposit to control a futures contract. If the margin requirement is high, fewer traders can participate because it takes more capital. If the margin requirement is reduced, suddenly trading becomes cheaper and easier. And that's exactly what just happened. The exchange quietly reduced margin requirements by about 22%. At first glance, that sounds like good news. Lower margin means more traders can enter the market. More participation usually means more liquidity. And sometimes that can even push prices higher. But the timing of this decision is what makes people nervous. Because this margin cut did not happen during a quiet market. It happened during a period of extreme uncertainty. Inflation is still stubborn, interest rates remain high, global debt is exploding, geopolitical tensions are rising, and many investors have been turning to silver as a potential safe haven. So when the exchange suddenly lowers margin requirements by such a large amount, it raises an uncomfortable question. Are they trying to stimulate trading, or are they preparing for something bigger? Historically, margin changes have played a huge role in the silver market. In fact, some of the biggest crashes and rallies in silver history were triggered not by news headlines, but by margin adjustments. Think about it like this. When margins are lowered, traders can control larger positions with less money. That means leverage increases across the system. And leverage is a double-edged sword. It can accelerate gains, but it can also amplify losses. In other words, the market becomes more fragile. Imagine thousands of traders suddenly holding bigger positions than before. If prices start moving quickly in one direction, forced liquidations can cascade through the system. One sell order triggers another, which triggers another, and suddenly the market drops faster than anyone expected. We've seen this pattern before. In the silver market, volatility is not unusual. Silver is historically one of the most explosive commodities in the world. When it rises, it can move faster than gold, but when it falls, the drops can be brutal. That's why professional traders watch margin changes very carefully, because sometimes these adjustments are signals, not official announcements, not press conferences, just quiet rule changes that insiders notice before the public does. Now here's where things get even more interesting. Despite strong narratives about inflation and currency debasement, silver has struggled to maintain consistent upward momentum. Every time it looks ready to break higher, something seems to stop it. Large sell orders appear, technical resistance levels hold, and the rally fades. Some analysts believe the silver market is heavily managed by large financial institutions and derivatives traders. Others argue it's simply the result of supply and demand dynamics. But one fact is clear. The paper silver market is enormous compared to the physical market. For every ounce of physical silver that exists, there are often dozens of paper claims trading in futures and derivatives. That means price movements are often driven more by financial positioning than by physical supply shortages. And that's why margin requirements matter so much. Because when leverage increases, the paper market becomes even larger relative to the physical metal. If traders start piling into speculative positions because margins are cheaper, the system becomes more sensitive to sudden moves. One small trigger can create a chain reaction. Now here's the part most people are missing. A margin cut can sometimes signal that trading volume has been falling. Exchanges don't like quiet markets. They want activity. They want contracts changing hands. Lowering margins is one way to attract traders back into the market. But there's another possibility. Sometimes exchanges lower margins because volatility has temporarily declined, making it seem safe to allow more leverage. But markets can change quickly. And when volatility suddenly returns, the combination of lower margins and high leverage can produce dramatic price swings. In simple terms, the market becomes a loaded spring. Right now, silver sits in a very strange position. On one side, the macroeconomic environment should support higher prices. Governments are printing money, debt levels are rising, many central banks are accumulating gold. Industrial demand for silver continues to grow because of solar panels, electronics, and electric vehicles. All of these factors sound bullish. But the price action doesn't always reflect that optimism. Instead, silver often moves sideways for long periods, frustrating both bulls and bears. And when investors get bored or impatient, they start taking bigger risks to chase profits. That's exactly the kind of environment where margin changes can have a huge impact. Because once leverage increases, the next big move tends to be amplified. Think of it like pouring gasoline on a small fire. Maybe nothing happens for a while. But if a spark appears, the flames can spread very quickly. Now here's the real question. Does this 22% margin cut mean silver is about to explode higher or collapse lower? The truth is, nobody can say with certainty. But what experienced traders know is that leverage always increases risk. If large funds decide to build bullish positions, lower margins could help push silver sharply upward. A wave of speculative buying could trigger a breakout that many investors have been waiting for. But if sentiment suddenly shifts, the same leverage could accelerate a drop. That's why risk management becomes so important in markets like this. The biggest mistake retail investors make is assuming the market will move in a straight line. They see bullish headlines and believe the price can only go up. But markets are rarely that simple. Behind every rally, there are traders taking profits. Behind every drop, there are buyers waiting for an opportunity. And sometimes the most dangerous moments are when everything appears calm on the surface. Right now, the silver market feels calm. Prices are moving, but not explosively. News headlines focus on interest rates and inflation, while margin changes barely get mentioned. But quiet structural shifts often matter more than loud headlines, because they affect how the market actually functions. And when the mechanics of the market change, price behavior can change too. At Past and Profit, we always try to look beyond the daily noise and focus on the deeper forces shaping the financial system. The 22% margin cut may not make front page news, but decisions like this often shape the next big move before anyone realizes what's happening. For long-term investors, the key is staying informed and avoiding emotional reactions. Silver has always been a volatile asset. That volatility can create opportunities, but it can also punish impatience. Some investors see silver as insurance against a broken monetary system. Others treat it purely as a trading vehicle. Both approaches exist in the market at the same time, and that mix is one reason silver behaves so unpredictably. But whether you're bullish or bearish, one thing is clear. The rules of the game just changed. Lower margins mean higher leverage. Higher leverage means bigger potential moves. And the next move in silver could surprise a lot of people. Maybe the margin cut ignites a surge of speculative buying, and silver finally breaks into a powerful rally. Or maybe it creates the conditions for another sharp shakeout that scares weak hands out of the market. Either way, moments like this are when experienced investors pay close attention. Because the biggest opportunities in financial markets often appear right after structural changes that most people ignore. Now, I want to hear your opinion. Do you think this 22% margin cut is setting the stage for a massive silver breakout? Or is it a warning sign that volatility and risk are about to increase? Drop your thoughts in the comments below. Your perspective helps start real conversations about what's happening in the market. And if you found this breakdown useful, share the video with someone who follows gold and silver so more people understand what's happening behind the scenes. Thanks for watching Past and Profit, and stay curious. Because in the world of money and markets, the most important stories are often the ones nobody is talking about.